5. Investment portfolio and capital appreciation. Don't wish it was easier. Wish you were better. Don't wish for less problems. Wish for more skills. Don't wish for less challenge. Wish for more wisdom. Jim Rohn. An investment portfolio may be composed of stocks, bonds, and cash. Your investment strategy will guide your day-to-day decisions on investing, both short and long-term. Portfolio planning considers the investor's financial goals and risk tolerance and time frame, among other factors. When creating your investment portfolio, you must also take into consideration asset allocation. Asset allocation is more than diversification. You need to determine, based on your financial goals, risk tolerance, and stage of life, what percentage of your portfolio you want to invest in the different investment classes, such as stocks, bonds, commodities, real estate, etc. Your asset allocation is your long-term strategy for diversified investing. Your portfolio strategy based on your overall investment objectives guides your investment choices and takes care of your future needs by achieving capital appreciation, namely an increase in the price or value of your assets. Your portfolio strategy takes into consideration not only your investment goals, but also your liquidity needs, risk tolerance, time horizon, and minimization of your tax burden. For example, a single woman in her 30s can invest in an aggressive fund that yields capital appreciation. In any case, on the off chance that you are a couple in your 40s with youngsters moving toward college age, you can't risk your cash in aggressive stocks that might suffer losses exactly when the cash is required to pay for your children's college education. Be that as it may, with retirement far later on, you may also need a portion of your cash in an aggressive fund, while most is invested in conservative choices. The same couple, when they reach retirement age, may invest most of their money in income-producing investments to add to their month-to-month retirement income. Therefore, your portfolio allocation needs to be based on your current and future financial needs and objectives. Risk tolerance is the degree of uncertainty that an investor can handle. For instance, risk-averse investors like to minimize the possibility of a financial loss, and therefore invest in lower-risk investments such as government bonds. The lower the risk, the lower the rates of return. The higher the risk, the higher the rates of return on investment. Are you risk-tolerant or risk-averse? The appropriate response is critical to your portfolio plan, and it might change after some time. An individual investor can build a portfolio plan alone or with the assistance of an experienced fiduciary. On the off chance that you are a conservative investor, your portfolio will have both capital appreciation and income. Conservative portfolios, as a rule, invest in conservative allocation of funds, hold a smaller amount of equities than moderate allocation portfolios, and have more lower risk than the aggressive fund portfolio. A solid financial plan incorporates a mission statement, a dynamic structure, investment objectives and strategy, risk profile, and a portfolio monitoring procedure. The expression portfolio investments covers a wide scope of asset classes including bonds, government securities, corporate securities, real estate investment trusts, REITs, common stocks, exchange-traded funds, ETFs, and certificates of deposit. Portfolio investments can likewise hold investments such as warrants, derivatives, and futures, as well as other tangible investments such as real estate, commodities, art, etc. On a bigger scope, mutual funds and large institutional investors are in the business of making portfolio investments, which may include large infrastructure investments, like bridges and expressways. Investors saving for retirement often invest in a diversified portfolio and low-cost investments such as index funds. Index funds have become popular in individual retirement accounts and 401k accounts. Investors who enjoy a more hands-on approach like to manage their portfolio allocations by including selected stocks and bonds and adding additional investments such as real estate and private equity. The capital appreciation on an investment is the increase in value of the investment. To know what the capital appreciation of an investment is, take away the initial investment from the current value. For instance, say you purchased 100 shares of stock for $75 per share, and they are currently worth $79 each. Taking away the underlying cost of $75 per share from the current value of $79 per share gives the capital appreciation of $4 per share. To determine the total capital appreciation, multiply the $4 per share increment by 100 shares, resulting in a total capital appreciation of $400. Of course, only when you sell the stock will you realize such gain. If the stock market were to go down and the price of your shares were to come down to $70 per share, you will have a $500 loss on paper. Due to the volatility in the stock market, the Internal Revenue Services, IRS, only charges you taxes when you sell your investment and realize a gain. For instance, say you own stock that has appreciated in value by $400. You do not owe any taxes until you sell the stock and realize the gain. You will have to pay taxes the year that you sold the stock. Capital appreciation does not include dividends, which are payments made by the company to the shareholders, and you also pay taxes on dividends received from the investment. For instance, say you purchase a stock for $75, and it has appreciated to $79, and it has $5 in dividends. While the capital appreciation is just $4, the overall return is $9, and you must pay taxes on the $9. The tax rate that you pay on the capital appreciation when you sell the investment depends upon how long you held it. In the event that you own the stock for a year or less, you pay taxes on ordinary income. If you owned it for more than a year, you pay taxes based on long-term capital gain rates. The 2019 to 2020 long-term capital gains charge rates are 0, 15, or 20%. Depending upon your taxable income and filing status. Real estate investors are permitted to take depreciation deductions depending on the wear and tear of the property. Those depreciation deductions give you a tax reduction now, but they also reduce your tax basis. For instance, if you purchase a building for $800,000 and you are allowed to claim $40,000 in deduction, then when you sell it, your tax basis would be $760,000. Paying as little as possible on capital gains taxes is significant. There are various techniques you can use to bring down your tax bill. Timing the sale of your appreciated assets is the best and least demanding approach to deal with your capital gains taxes. Remember that paper gains are not taxable. You'll only pay taxes when you sell those investments, and it's always up to you when you sell them. Ensuring that you hold on to winning investments long enough to get the lower capital gains tax rate is a popular tax strategy. That doesn't mean it always works. Sometimes an investment makes money shortly after you purchase it, and holding it for the whole year may not work because the investment may also decrease in value. However, if you are close to the 1-year mark, holding on to the investment may make a difference between a large and a much smaller tax bill. Investors often take capital losses to offset any capital gains that they may have in their portfolio. This tax strategy is often done toward the end of the year as people begin to plan to file their tax returns for the year. It is important to remember that you do not pay taxes when selling investments inside a qualified retirement account, such as an individual retirement account, IRA, or 401k. Retirement plans. There are many kinds of retirement plans, including IRAs, Roth IRAs, 401k plans, 403b plans, simple IRA plans, savings incentive match plans for employees, SEP plans, simplified employee pension, SARSEP plans, salary reduction simplified employee pension, payroll deduction IRAs, profit sharing plans, defined benefit plans, money purchase plans, employee stock ownership plans, ESOPs, government plans, and 457 plans. For assistance to select the right retirement plan for you, visit this link, https://www.irs.gov/savings_retirement.pdf. 401k versus IRA. The 401k retirement plan started in 1984 and gave employees the opportunity to participate in the stock market and save on taxes by making tax-deductible contributions to their paychecks. The greatest distinction between the two most well-known kinds of retirement accounts, 401k and IRA, is that 401k plans are set up by employers and IRAs are individual retirement accounts. With 401k accounts, contributions are made on a pre-tax basis. Contributions to IRA accounts are made post-tax income. However, deductions are available for these contributions. With both IRA and 401k plans, investments grow on a tax-deferred basis. However, at withdrawal, taxes are due at the then current tax rate. There are different contribution limits and tax considerations for both retirement accounts. Most plans offer a spread of mutual funds composed of stocks, bonds, and money market investments. And it is important for you to know that these mutual funds have many different fees and costs between the underlying investments and the plan administration, which reduce the overall investment returns. For more information about these retirement plans, visit the following link, https://www.diffen.com/difference/401k-VS-IRA. A Roth IRA is an IRA used for retirement savings. The Roth IRA has no withdrawal requirements and tax-exempt qualified withdrawals after age 59 and a half. To qualify for a Roth IRA, you must have earned income and meet adjusted gross income prerequisites. You can start taking tax-exempt withdrawals after 59 and a half and keep making contributions after age 70 and a half. The yearly contribution limit for 2019 and 2020 is $6,000 or $7,000 in the case that you are age 50 or older. On the off chance that you own a business, you can start an SEP IRA. An SEP plan permits employers to add to conventional IRAs, SEP IRAs, set up for employees. A business of any size, even independently owned, can set up an SEP. For detailed information about retirement plans, go to this link, https://www.irs.gov/retirement-sponsor/plan-of-retirement-plans.